The trade war and inflation are making investors nervous because we just saw the Dow Jones fall by more than 700 points. This time, the catalyst was inflation, because we just got a new report saying that inflation is apparently still a problem, and it came in hotter than expected, which kind of spooked Wall Street. But if you've been using your salary to buy groceries, you might have already known this. But that's just the tip of what's happening. We also have the new 25% tariff on foreign cars, which has some investors worried about the impacts of that on the economy. We have US consumer sentiment coming in now at the lowest levels since November 2022. And then we have the cherry on top, which is the Federal Reserve Bank now stating that they expect the economy, or GDP, in the first quarter of 2025 to fall by 2.8%. Why does that matter? Because just a few days ago, they said that the economy would fall by 1.8%. So in just a few days, they revised their estimate to a whole 1 percentage point lower. And this is where some people are finding a lot of fear, but there's also opportunities, because amidst all the chaos, gold prices were also breaking new record highs. Now you might be saying, well, is this a time to stress? Well, if you look at what the Federal Reserve Bank is saying, they're saying no. Jerome Powell, who is a chairperson at the Federal Reserve Bank, recently came out and he said, you don't need to worry because the rising prices will be, quote, transitory. Yes, he said the transitory word again. And the reason why I'm saying that is because we first heard the term transitory in 2020, 2021, when the first fears of inflation were starting to come out. And the Federal Reserve Bank, along with the White House, says you had nothing to worry about because the inflation problems are just transitory. And it took about 18 months before the Fed and the government retracted that statement saying inflation was not transitory. So just kind of a funny full circle moment. So let's break down what's actually going on from inflation to tariffs to the economy, starting with inflation. And I want to start with this. Inflation compounds. The inflation that we're seeing in 2025 is on top of the 2024 inflation, it's on top of the 2023 inflation, it's on top of the 2022 inflation, and it's on top of the 2021 inflation. And the reason why that matters is because the Federal Reserve Bank does not want to see the prices of things fall. They want to see the prices of things rise less quickly than what they've been, because the Federal Reserve Bank has a target of 2% inflation. They don't have a 0% inflation target. They want to see the prices of things rise by an average of 2% because they feel like 2% is low enough that the average person doesn't notice it day to day. The problem with that is we are not at the 2% number yet. And often we keep getting the news that inflation is coming in hotter than expected, which means the prices of things are still rising and they're rising above the Federal Reserve Bank's targets, which means if you rely on a salary and your salary growth is not keeping up with inflation, well, you're effectively becoming poorer because your salary cannot buy you as many groceries, as much rent, as much airfare. And that's just based off of the reported inflation numbers. If you believe that inflation is actually higher than that, well, you can start to see why that's a problem. And so right now we still have the concerns about inflation, and then we have the concerns about tariffs making some of the inflation problems worse. And this is something that we've been covering pretty heavily in Market Briefs. Again, Market Briefs is my free financial newsletter where every day my team is breaking down what's happening in things like the economy and the stock market and the housing market, the crypto market, and the global economy into a fun, witty, and easy to read newsletter. It's completely free. We have hundreds of thousands of investors that are reading Market Briefs every single day. So if you have not joined Market Briefs yet, again, I have the link for you to join down in the description below. Now, when we have tariffs going on, I want to remind you, tariffs are a tax. It's ultimately paid by the person who is bringing the product into the United States. So if you are a car company and you are importing a car into the United States, you will now be forced to pay a 25% tax, which means if you don't raise your prices, you are going to see a big hit on your margins. This is why some people are concerned that the prices on certain cars will go up because the car manufacturers, the dealers will be forced to pay an additional fee to actually get that car. Now, there is a way around this. The way around this is you can bring your manufacturing into the United States, but you can imagine that that takes time and there's an additional cost to produce your product in the United States as opposed to, say, Mexico, where the labor costs are cheaper. So when you have more and more of these tariffs happening, it creates a lot of uncertainty. And the reason why that matters is because Wall Street does not like uncertainty. And we don't know how many companies are going to bring their manufacturing back into the United States. We don't know to what extent these tariffs will stay. We don't know to what extent countries are going to retaliate with more tariffs. And we don't know if we're going to see more tariffs added on next week. That's why it creates more uncertainty. And Wall Street doesn't like uncertainty because uncertainty means that you could potentially lose money, and that's what creates some investors or traders to panic. But it also creates opportunity. So stick with me through that. The third part that I want to talk about before we get into kind of how do you find the opportunity has to do with the economy. And I want to talk about specifically the consumer sentiment report, because while the consumer sentiment report doesn't actually give you a real picture as to spending, a real picture as to what's happening in the economy, it gives you a picture into people's emotions. And the reason why that matters is because when people feel confident in the economy, they are more likely to spend. If you feel confident that you're going to keep your job, you are more likely to buy a house, to buy a car, to go out and buy a vacation. But if you're worried that your company is about to go bankrupt, you might be less likely to make a big spending decision. You might be a little bit more frugal. You might be more into saving your money. Now, saving your money is good. Being frugal is good. Being smart with your money is good. But when we look at it from the economic perspective, the economy profits when you spend money. And so when you get the report saying that consumer sentiment is now at the lowest level we've seen since the late 2022 times, that indicates that potentially people might pull back on some of their spending because they're getting a little bit concerned. Now, there is a reason why people are concerned, because they see the volatility in the stock market, they hear the news about a potential recession, so that naturally has people concerned, but it's something to pay attention to if we really start to see a pullback in spending, which we have not seen happen yet. People are still spending money generally, and credit is still rising, which is not a good thing for you if you're going deeper into debt to spend money. But from an economic perspective, that means that the economy is still growing. And then, of course, we have the Federal Reserve Bank, who is now coming out saying that the economy is going to slow faster than expected. And this is from the Federal Reserve Bank of Atlanta, who essentially is saying that we thought the economy was going to slow, but now we think it's going to slow even faster, which has some investors on Wall Street looking for alternatives, safer investments, which is one of the reasons why we saw gold prices rise, because gold has traditionally been known as a hedge against uncertainty, a hedge against inflation, and kind of just like insurance against bad things happening. Which now brings me to probably the most important part of this video, which is, what does this mean for you? And the reality is, it might not mean anything. And that's what I want you to remember. If you are a long-term investor and you have at least 10 years in your investing career, so you're under the age of, let's just say 55, it really shouldn't mean too much. Because if you are really a long-term investor, well, you know that market crashes happen. In fact, we know that on average, we see more than one market crash a decade. And I'm not saying that the markets are going to crash next week or that we can predict what's going to happen, because anybody who claims to have a crystal ball is just plain out lying to you. But the reality is, we know markets go up and down. It's a part of our system. But we also know that market downturns and uncertainty and fear create some of the best buying opportunities in the history of time. You can look at the history of the markets and just see how it has played out. Over the long term, we have seen markets go up. This has happened decade after decade after decade, and each time you see a downturn, each time you see any sort of economic pain, you see the same factors. People say this time is different. People say we're not going to recover. People say you want to get away and never invest your money. But the brave people who go against the grain and are willing to cut out the emotion, are able to find the opportunity, are the ones that are generally able to profit, and not just that, be able to find big investment opportunities that you can't find in other times. And this is where, again, it is so important for you to be able to, number one, cut through the emotion, take a deep breath, stay calm, and now look for the opportunity. Now, as you start to identify the opportunity, you'll realize that, hey, I need money to invest. This is why you need a money system. That means always having money to invest. Always now knowing how to live below your means. Essentially, not spending all of your money. And so if you can get that, now you don't spend all of your money, you put money aside to save, you put money aside to invest, you can pay down the credit card debt if you have any, because if you have credit card debt, My thoughts as a random guy on YouTube is that you should pay down the credit card debt before you invest your money. And now you have money to invest, that's when you can start looking for the opportunity. Now look, I'm just a random guy on YouTube. I'm not a financial advisor. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point, so make sure you always do your own due diligence. Never blindly trust a random guy on YouTube. But if you look at the history of the markets over the last 10, 20, 50, or even 100 years, we know that market downturns and recessions create more millionaires than any other time. Which means, if you can cut through the emotion, if you have the money to invest, well, now you can start looking for more opportunities. That's the game that you want to be thinking of. Instead of getting caught up in the emotion, instead of getting riled up and freaking out or getting excited, look for the opportunities. That's what the financially savvy are doing. That's what Wall Street does. They don't get caught up in the politics. They don't get caught up in the emotion. They want to ask one question. Where is the money moving? Period. Anytime you see something like tariffs, inflation, consumer sentiment, you hear these big headlines. The question that everybody in Wall Street asks is, where's the money moving? When you have concerns about consumer sentiment, you have concerns about people being worried about a recession, what do people do? They turn to retail stores that are more budget friendly. They turn to ways to save money. That creates a potential investment opportunity over there. When you hear about news about tariffs, well, if there's more manufacturing that moves into the United States, that creates an investment opportunity because there's going to be companies that have to build those plants. There has to be logistics companies that move parts from one manufacturing facility to the other. And this is why, again, you got to start reprogramming your mind to start not getting caught up in the emotion and instead look for the opportunities, because that's where the real wealth is built. And my goal for you is to be able to understand this. That way you can take better care of yourself, better care of your family, and better care of your community. But that starts with you understanding how our financial system works. Wall Street knows how to use it to their advantage. And I want you to learn the same game that they're playing, because yes, you can win the same way that they do as well. And with that, I'll see you on YouTube on Monday.